So thank you for inviting me again. And it's really great that Evelyn also came to an event at Prospect where we're discussing the issues of the war in Ukraine and what it actually means in terms of energy shortages that there may be and what it means for inflation. So there will be a little bit of that I cover, because obviously, you know, as you were suggesting at the beginning, disentangling everything is quite difficult, particularly since now we have COVID, Brexit, and the war in Ukraine to contend with. And it's a pretty hard job for most econometricians to try and separate the three. And I may not succeed, and I'm not probably going to be able to do that anywhere, even try particularly hard, but at least we can get an idea of how they all interact with each other. So if I can take you through what's happening to the world economy and the issues there, and why some of the inflation that we're seeing right now is influenced by all sorts of different aspects of what's been going on, and not just of course the war, but loads of other things as well. And then we can perhaps get to some sort of conclusion at the end that we can, or at least some tentative answers that we can discuss between us. So let me just take you through what's actually happening, and please do interrupt if you want to, but I'll go through it at a reasonably rapid pace and hope it works. Now, we're talking about long COVID. I mean, COVID is still with us. We use the term long COVID, of course, to refer to individuals that have got COVID and they can't recover from it. The way that I'm using it here is that COVID leaves a lasting impact on the economy. There is a lot of GDP that was lost in the process that we're just probably not going to be able to recover. Because even though we are slowly getting back in terms of growth of the economies, reaching pre-pandemic levels, what has happened, of course, is that in order to capture all the losses that we have had in GDP in the last 2 years, we need to really grow quite fast in the future. And we need to make sure that some of the things that have been left in the various economies, all these scarring impacts that we're talking about, possibly particular sectors of an economy having suffered and therefore never to recover, possibly changes that are taking place in the structure of an economy anyway, possibly also different ways of working or whatever it is that we do now as a result of COVID, the impact on the health services, which are likely to be long and persistent. So that is really what we're referring to as long COVID. And of course, we have COVID still in a number of places. I get the World Health Organization's data on a daily basis, and it's frightening to see how the overall figures are still going up and going up quite substantially. Of course, the number of deaths is reducing in terms of the sort of daily rota that we get. But look at, for example, what's happening now, of course, because of the war in Ukraine. The interesting thing about trade is that it really matters. Of course, it matters for us. We were particularly linked to Europe. Now we're trying to do different types of trade deals. But what we also know is that trade is really important. There has been all this discussion about deglobalization. But in reality, the moment things opened up, despite the issues of supply chain that we had during the worst bit of COVID, trade just rose very, very significant. That's the trade slide I'm showing you here, which is actually pretty similar to the way that GDP across the world also recovered. So instead of onshoring suddenly or cutting supply chains and thinking again, everyone went back to trying to get goods the way they got them before. But of course, the problem was and is that some of that supply wasn't there. Lots of firms had just completely stopped ordering things, so manufacturers were not producing the inputs or the parts that you need for cars, for example, because you didn't want them. You had cancelled your orders. So the Chinese, for example, which had a relatively short, sharp fall early on in 2020, but then recovered, the only big country to have seen a rise in GDP in 2020, whereas everyone else saw a recession, it didn't produce all those electronic components that we need. In fact, it sent all these semiconductors and so on to be used for computers and telephones, rather than for cars, which is the sort of things that we demanded quite a lot. But trade it didn't actually fall anything like as much as had been forecast. The forecast had been that it would drop by anywhere between 13 and 33%. Well, it didn't. It dropped by less than 10%. In fact, it was about 7%. The drop in goods. Services, of course, fell more sharply because, of course, we had restricted the movement of people, restricted tourism, so restricted movement of people, of students. All that, of course, had an impact overall. But what they're doing now is that after this serious improvement that was taking place, superimposed on that has been the war. And of course, you know, trade recovered, but so did the cost you had to pay to transport goods. Freight rates rose very significantly. And with the extra demand, of course, the price of all these goods went up as well, and fuel costs went up and so on. And then you had the war, and things got worse. So the forecasts have now been reduced to just 3% growth this year. It was pretty optimistic before. We saw something like 11% last year, and the forecasts were for possibly 5 and more for this year, but that's all been downgraded right now. We know the stories of all these ships which are stuck in the Black Sea, can't actually get out of the Ukraine. So that is an issue. So it looks like long COVID has now also been affected worldwide by possibly long war, because the war is not likely to finish very soon. So it creates all this uncertainty. So if you look at the war impacts, and then you look at China, of course, having COVID right now and closing down again, I mean, what we are in is for the possibility of global recession, or at least stagflation. I mean, prices going up, as we know, and growth really slowing down. And the way to read this slide is you look at the sort of global PMI, which is the producer price, the purchasing managers index. So you ask, this is big surveys that ask companies, what is your output doing now and what is it likely to do in the future? So the line that tracks GDP more or less is the yellow one, which had improved quite considerably after the drop in 2020. After the initial drop, if you've seen through the year, things were improving, and then went way above the 50 indicates, so the lines that are there across the red one, for example, line, which is the 50 line. Anything above, the way that it's calculated, shows an increase in activity. Anything below is a contraction. So in terms of the actual output, we see that after the pickup, things have slowed down and getting very close now back to 50, which is a worry. Of course, if you ask any firm what they intend to do for the future, which is the green line, then you can see that they're still quite optimistic. They obviously are hoping that the war will end. The same for the International Monetary Fund. They've got that as their baseline assumption. But of course, there is huge uncertainty built in there. And of course, you see that everywhere. I mean, the US had a drop in GDP in the first quarter, which is really surprising. If you think again about the US, it had the least drop in GDP of any G7 country and was at pre-pandemic levels into the year, more or less. And when they got there much more earlier than anybody else, and yet it had a drop in GDP. There are all sorts of reasons, inventories, worries about the war, what companies do on a monthly basis matters. But anyway, it may not stay there for any length of time, but for the moment we saw a drop there. And you can see the potential GDP, that's the scarring from COVID and also the scarring now from the war. The scarring from COVID has a lot to do with prices as well, of course, but real serious worries about what is happening with energy prices. Even though US is self-sufficient and we're getting a lot of our liquefied natural gas now from them, which they're directing to us, to Europe, to replenish anything we don't have from Russia, it's still a big gap. So there's a potential GDP that has not quite got back again, which actually therefore means that something needs to give, or some much faster growth needs to happen in the future to make up for it. But it is a worry, it's a big economy, and it showed a drop in GDP in the first quarter, and everyone is worrying about recession or stagflation, which I'll talk about again in a minute. Well, in Europe it's worse. to a considerable extent, because of course everyone relies on gas from, apart from us, from Russia. And you can see here the very substantial input of gas. Oh, sorry, this one is crude oil, but also gas. I should have shown you the gas pipelines, which are extraordinary. This is oil. We forget about oil. We talk about gas. The interesting thing is that Russia gets 40% of all its revenue from exports for its government, for the public finances, from oil and gas taxation, which is really quite interesting. And we forget that that oil is so significant as an input into loads of countries in Europe as well. Some 40% actually of all oil exports from Russia go to Europe, and some countries depend on it quite significantly. So when we're talking now already about stopping the purchase of Russian oil by the middle of this year, this is what the European Commission has recommended, and petroleum products a little bit later, you can see the impact that this will have on a number of countries. And when we're talking also about blocking gas, then that's a big issue. Now, of course, even if we don't block it, Russia is in trouble. It's another country which is seeing a reduction in GDP. And of course, it has to spend a lot of money on its war, but also sanctions are biting. Yes, the ruble is improved, but that is mainly because of capital controls. But we're seeing the entire region of Central Europe and Asia fall into recession this year. So all this is a worry, obviously. So thinking again of the exam question, disentangling everything that's happening in terms of growth, inflation, and so on, from all those issues is not easy at all. And within all that, of course, we've had this reevaluation of world GDP downwards by the International Monetary Fund. And this is the latest forecast for the UK from the Monetary Policy Committee. And you can see here that we're getting to 2023 and there's really no growth, which is a worry. And of course, you know, a number of us would have said and have said the UK is moving itself into a lower trade intensity, which I'll talk about later. That has made things worse anyway. Yes, of course, we recovered, but we had one of the biggest drops. We had worse supply chain issues than anybody else, possibly higher prices, which I'll talk about in a minute. But it's very, very worrying that looking ahead, we've got this serious slowdown. But interestingly, you know, people say, yes, everyone is, but no. The International Monetary Fund calculations show that the revision in forecasts for the UK for 2023 are the biggest of any other of the G7, and we have the slowest growth in GDP for 2023 as a result. So we need to get back to that in a little while and see what possibly Brexit may be doing to those figures. And but just going back a little bit again, I mean, clouds were gathering, of course, before, as I put it here. I mean, all sorts of things were worrying us. So if you're trying to at least take the war out of this and think about COVID, since long COVID is one of the issues we are discussing, what happened in this particular crisis is that there was a huge increase in debt that took place by both the advanced and the emerging countries. And that, of course, has been a worry of policymakers in terms of what it means for inflation for the future, but also what it means for managing this huge increase in sovereign debt that seems to be happening. This compares what happened in the global financial crisis with what happened now. This time around, we're all encouraged, yes, go out and borrow as much as you can. By we, I meant individual nations. Instead of the usual concern, be careful, don't over borrow, but actually we did. So these are the changes in debt that took place, and the stock has gone up very significantly. You see these increases in stock in 2019 and 2020, so the last couple of years, we saw this very substantial expansion in debt. And of course, it has continued in 2021. And we haven't seen the complete figures for all these countries, but look at the US, huge input into the economy. Look at the world overall, And that is, of course, that was necessary in order to get the economies moving. But with it, of course, they have led to quite a substantial expansion in liquidity in the economy and some of the problems that we have now with inflation. And the World Bank now worries that 60% of the poorer nations, partly because of the food price increases that we have seen, mainly war, partly, a hangover from the COVID period because they were all increasing anyway. Some 60% of poorer nations are in trouble, are already in difficulty with their debt. And we're seeing the unrest that is happening everywhere. Sri Lanka, we're already seeing that. It's happening in Pakistan, in Iran, in Lebanon, in quite a lot of African countries as well. But with it, of course, what we had was quite a substantial increase in private sector debt. And that's the worry. And I want to talk a little bit about that and inflation and what it all really means for the future. So the support was necessary because without it, we wouldn't have survived the big COVID period of inactivity. But what happened, of course, with very, very low interest rates, which were a sort of coordinated move by the authorities, we saw a huge increase in debt taking place. In fact, it was the largest surge in debt in 50 years in 2020. I mean, remember, it was all going up anyway through the financial crisis, and it's now carried on going up quite significantly. And of course, it has brought this inflation increase that we all talk about right now, and the cost of living crisis. So there is a question mark. Was it all caused by excessive monetary liquidity? How much of the war is the war in the Ukraine to blame? And of course, the banks central banks were very significantly involved in this because they had to increase their own balance sheet by buying all these bonds in the secondary market and financing the various deficits that governments had. So the monetarists will say it's all the fault of the central banks that didn't stop doing that early enough. They didn't raise interest rates fast enough. All that discussion that's going on right now. And they say that is really what has led to the higher inflation that we're seeing at present. And remember, these are average figures for the year. They already take into account the 9% rise that we saw in April. The expectation is that that's going to come down in the UK. But you see this happening almost everywhere. It's interesting when you look at Japan, just to remind you, I mean, Japan has had deflation for a long period of time and is probably jumping up and down with joy that it finally has a bit of inflation to show, because deflation is also bad for the economy. And one of the reasons why the European Central Bank has not raised interest rates, even though the euro area is having quite high inflation, is because it remembers the deflation it had to endure and the fact that it raised interest rates twice in 2011, not realizing that the Eurozone was falling back into recession anyway. And then we had the long Eurozone period. So let's try and understand the inflation and therefore understand also what it means in terms of the various factors that have contributed to it, and hopefully get to Brexit too at some point. I mean, what we've seen across the world is that there are imbalances caused by COVID in the labor demand and supply. This is the US. And remember, the US was a very weird country in terms of what it did during COVID. Instead of doing what we did, which is the furlough scheme, and supporting people to be kept in employment, they just let everyone lose their jobs, and unemployment rate went up to 14% or thereabouts, and higher, and just put checks through people's doors. And then as the economy started to recover, so people had loads of money, it was not worth even trying to get a job because unemployment benefits went up. So people saved quite a considerable amount. In fact, there was reluctance to go back to work. So what happened was quite a tight supply of labor, which is continuing, which has, of course, contributed to the increase in demand, in inflation that we have seen. And that's been a problem for them. It has not been a problem in other countries in Europe, where unemployment, though coming down, is still very high, but it has been a problem here in the UK. So we had a similar tightness in the markets, even though obviously the path was different because of what I said. We didn't have this huge increase in unemployment. And but what we found in the UK is that there's been quite a lot of people leaving the market, but also, of course, we've had people not wanting to go back to work after the experience of COVID, but also leaving the UK through, partly because of COVID, they went back home, didn't come back, but also, of course, because of Brexit. They decided they were not welcome back here, so they did not return. So there is an issue about that, and I'll talk to you about that in a minute, because there are a number of serious economists like Adam Posen, who was in the MPC, who thinks that something like 80% of the inflation that we're seeing in the UK is because of Brexit, which is quite an extraordinary figure. But let's just remind us what else there is. There was, of course, a food price hike from before. As you can see what happened in 2020 up to a point in 2021. It is worth bearing in mind that in the early part of the COVID lockdowns, loads of prices went down. But also what happened at the time is that not only did food prices go down, but so did commodity prices more generally. We had negative oil prices for a while because nobody was driving, for example. And so then, of course, everything came back with a vengeance. People say it's because we put all this money into the economy, perhaps, but I think supply wasn't able to respond quickly to demand. But look what's going on right now. This is really the Ukraine effect that has been very, very significant. It's not very surprising, the Ukraine effect and Russia effect. We know this data, sunflower oil, wheat. There are loads and loads of shiploads with grain waiting to come over here now, but they've been blocked by the Russians. So that's another problem that we have, which is contributing to inflation. So that's the part of the explanation. But of course, energy prices, this is just a reminder of where we are in terms of oil. It goes up and down a bit, suddenly rose to pre-pandemic levels and then more. But remember, what the expectations were for quite some time was that we get back to pre-pandemic levels. That was pre-war. And then things have stabilized. And if things stabilize there, then what we would see is, yes, a pickup in inflation, but then nothing after that. So zero inflation, practically. You would just change the situation very dramatically. Then we had the war. So certainly you can see the changes which are war related. From here on, when we really started worrying about what would happen early on, and then of course the invasion in February and the real jump. It goes up and down partly because the closures in China meant they didn't demand as much energy, but also because the US particularly has sent loads of, as I said earlier, liquefied natural gas to us, which of course, it's not just the oil thing, but I've got the gas thing here, which also went up and down a bit. And that has of course partly reflected the dependence of Germany and others on gas. But even though we don't ourselves import a lot of gas from Russia, we pay for this in the global market. So prices are down, prices are up for us as well, although there have been periods where they've been coming down, up again, down again. It's a very, very volatile market, but you can see the trend is still very significantly upwards. So that has contributed, of course, to inflation. So to get back then to trying and see what all the measures that were introduced, in fact, did, and how to judge what's going on. This is the Monetary Policy Committee's own slide, which just shows what they did in terms of over a number of years of reducing interest rates, is how low they were. That, of course, has contributed to everyone sort of asking for mortgages and loans more generally, supporting business. This is QE, which is quantitative easing, and how it sort of moved up very, very substantially with COVID. Now, why do we worry about QE, and how do we understand what's happening really? So is QE to blame for some of this increase in inflation? Well, yes. I mean, the way it works though is that it reduces yields because the Bank of England comes and buys bonds in the secondary market. It allows the government, of course, to issue those bonds because there's a willing buyer there, in the sense that investors buy, then the Bank of England comes and buys them off them. They make a gain is fixed interest rates. So the yield on those bonds goes down. That affects all the loans. So you see that at the end of the day, what it does is it allows people to borrow, invest in other assets, gives them high returns, so wealth improves, etc., and all that boosts economic activity. Low interest rates assist in that. That's how it works. And this is sort of merry-go-round. So the bank issue, this is the US doing exactly the same, buys these bonds, people put it in banks, then they use the cash, or they also, a lot of it goes into financial institutions, use the cash, spend it, it goes back again. So it helps the economy, which all sounds great. So assets increase, of course, very substantially. It's one of the concerns that everyone has. And look what happened to house prices in the US alone. We know the house prices are rising here, but this is 30% increase since COVID started, which is extraordinary. So these are the levels where we are now by comparison to February 2020. We've had over 10% increases in the UK, helped a little bit by special measures like the stamp duty relaxation. But also, of course, people are screaming because it has increased inequality. This is a Guardian slide which just shows how, of course, things have changed a little bit for Elon Musk just recently, but nevertheless, it shows from the beginning of the pandemic, so they looked at March 2020 to January 2022, that the 10 richest billionaires had managed to increase their wealth and quite considerably. In fact, they had doubled their wealth. So there are concerns that quantitative easing, as it worked, perhaps also increased inequality. So what's happening now is that its interest rates are beginning to go up, and that's the expectation. The US is already doing it. Lots of other countries are raising rates. Europe might raise them in the summer, but of course that's going to lead to greater concerns here too, in terms of what type of growth you're going to have. And we can see here already what the Bank of England has done. It's raised them. It's got the EU referendum, of course, when it had to step in and do a lot of QE, if you remember in the earlier slide. So one of the reasons why we are where we are now in terms of all this money having been put into the economy and causing inflation is because they had to step in to stop the financial meltdown when the vote to leave the EU happened here. So you can take it, therefore, back to that. So that's the that's the impact of Brexit. That's the impact then of COVID. So, and going back to the earlier slide, if you remember, that was similar here. This is what happened after the referendum vote. A lot of QE was carried on to ensure that the markets would respond positively rather than negatively, and that interest rates would be kept low and that the economy would continue to perform. So you can see the impact very clearly. So all that was put into the economy, was not taken out, and then we had to add more because of COVID. So you could argue very easily, if you're trying to disentangle COVID from Brexit, that we started from a very high base in terms of the liquidity that we had to put into the market because of Brexit, and we added a lot more, and possibly the inflationary impact wouldn't be anything like as big as we're seeing now. There wouldn't be the sort of issues with the governor, who wasn't, of course, running the Bank of England at the time. So that's something to really bear in mind as we're looking at the response of the MPC, and the fact that interest rates were kept so low in the UK by comparison to other places because of the referendum. You see, we had to lower our rates at the time, and of course the exchange rate suffered. So when the exchange rate suffers, inflation goes up. So all these things are very Brexit related, and they leave a scar, they leave a lasting impression as well. But let's look then at the latest. This came out, what is it today? Yesterday. There was a talk by Michael Spencer, who is an MPC member who's about to, Michael Saunders, I apologize, who's an MPC member who is just leaving the Monetary Policy Committee. And this is what he calculated impacted on inflation since COVID started. So going back to the exam question, it's interesting because, of course, there were big supply chain issues that hit us at the beginning of the recovery from COVID. And of course, the UK had quite a lot of issues with supply chains because of the disruption of trade that we already were having with Europe. And also, so this is the green bar. And of course, the green bar gets bigger. It gets a little bit better now. It got a little bit better, and they accept that this is a little bit better as the last data that they looked at. This is early 2022. But then also look at the labour shortages, which are quite considerably linked to Brexit. And they are quite significant. Look at the yellow bars that are there. So this is the Brexit trade costs. And these are the, quite likely, up to a point, the Brexit labour costs, which are contributing quite significantly to inflation. Yes, of course, you've got energy inputs there. You've got supply shortages. You wonder how much of that in itself could be Brexit related. So this was his calculations of this. And of course, there are loads of others who go a step further in terms of the way they perceive the trade issue. So I've got this here because it was part of something I wrote looking at what Professor Adam Poser, who was on the MPC, has also been arguing. So of course we know that there is more tightness in the UK labour market here than is the case in the Eurozone. That has been well documented. And Brexit, of course, is one of the reasons. And that, of course, adds to cost pressures. So again, think about inflation. And of course, supply chain issues that I mentioned, they are very important, and they've been exacerbated by Brexit. That has been well documented by the IMF, by the OECD. So it's not something that one needs to make up at all. But what we've also seen is that loads of sort of data and reports recently which suggest that the problem, in fact, may be greater than we thought. I already mentioned that Professor Adam Posen is arguing some 80% of the inflation we're seeing is due to Brexit. And the reason for that, of course, is because of his concerns about the tightness of the labour market and the supply chain issues that we've got. And this is why, as he thinks, we're likely to have the highest inflation in the G7 next year, which is, of course, what the International Monetary Fund is suggesting. So what he's saying is that if you look at the Eurozone countries' increase in inflation, this has been mostly a reflection of higher energy and food prices, whereas he thinks that for the UK, it's Brexit, which is going to restrict the supply of labour over the longer term, and the trade restrictions that are keeping prices higher than they would otherwise be. Now, of course, when you look at the latest data, actually it is energy and food that seem to be dominating. So we've got to bear that in mind, but that is, of course, because we had that increase in the electricity cap. So it's one of the reasons for it. So, but this seems to be now becoming quite an established view that Brexit has certainly contributed to this inflation increase. And if you look ahead, of course, the extent to which that is true, that would also be affecting the expectations for growth. And those were the figures we thought were going to be happening before COVID hit. This is actually where we are. And the question, of course, is disentangling how much of that slowdown, because obviously the higher interest rates are, the higher inflation is, the more of a cost of living crisis there is, the more of a problem there is for firms, and the slower growth is. So that's one element. Then I very quickly, and I will finish in a few minutes, show you the work that is done in terms of disentangling COVID, at least, and Brexit. And that is happening, that happened from the very beginning of the actual implementation of Brexit. where firms were asked, is it COVID, is it Brexit? And the Brexit line is the blue one in terms of percentage of firms that are saying they're having difficulty importing, and those that are saying they're having difficulty exporting, whereas the green one is all to do with COVID, which of course, had got much easier, and yet the overall problems remain quite high in terms of importing and exporting. Now you say this is the beginning, but actually it seems to have continued. This is what the Office for National Statistics prepares in terms of the export and import challenges compared to a year earlier, and you can see this is January 22, over a year earlier. This was the first year of Brexit. Additional paperwork, you see the percentage of firms affected by all this. So this is quite major. So obviously, we all know that trade is good for the economy. If that is affected, that's a big issue, which we need to be aware of. And what we've got in this January 2022 report is, again, much more clearly this percentage of firms that are finding it more difficult to export and more difficult to import. And you see that that's been going up recently, went down a little bit for a while and then gone up recently, and it remains as a very substantial percentage of the firms. We also know that there's been a bit of a change in the composition of firms that are exporting. I mean, this is an interesting one from the London School of Economics, which said that in fact most of the change that happened in our trade has been since the implementation. In other words, from the beginning of 2021 of the agreement, the new trade and cooperation agreement that we signed. So what they're saying is that if you look at the intensity of exports and imports, you really need to look at this last bit here in pink. Until then, they claim nothing very much changed, and our exports haven't done particularly badly. But what we've seen is that certainly in terms of exports, there hasn't been a huge amount of change. Where the change has really been is in terms of imports, where this loss of trade with Europe clearly shows. So here we are, COVID, okay, getting out of COVID at the end of, sort of at the end of 2020 or during 2020, and then 2021, where we're beginning to recover and recovered quite strongly. But then, of course, we're also left properly. We implemented the agreement. And what has happened really, it's on the import side, even though we hardly have any checks on imports, but the ties have been broken. What they're also finding is that on the export side, loads of small firms left. So the composition of exporters has changed from small firms to big ones, which of course, didn't really need an awful lot more extra help. They were already reasonably efficient. What you need is loads and loads of companies in an economy exporting, because that increases competition and also increases productivity, because you have to get your products to a market where you're competing sort of regularly. So what seems to be happening is that over a period of time, our links with Europe have gone down, and of course that has exacerbated the supply chain issues, which of course has exacerbated the inflation from. So you can disentangle it, therefore, this way. And you can see it, I mean, interestingly enough, yes, okay, perhaps some exports to Europe have not done particularly badly recently, but what seems to be happening is that we've got a real increase in non-EU imports, whereas we have we have quite low EU imports. That costs more, comes from further away, it's more uncertain, etc., etc. So there's been this change in the composition of our trade. So to finish off, it does matter. There is a question of what happens next and how inflation will be affected by, let's say, a trade war with Europe because of the Northern Ireland Protocol. You also know full well that Catherine Barnard has done quite a lot of work on what the EU would do in terms of retaliating. It doesn't look particularly good. But what I can say is that the headline in the Telegraph of a few days ago was, inflation could increase significantly in the UK if the EU retaliates. So I think there will be plenty for analysts to do if they're trying to yet again disentangle the inflation impact from Brexit or of Brexit from all the other impacts. And of course, that means growth in the UK economy will be considerably lower than would otherwise be the case. So I'll stop here, if I may. Thank you.
Thank you, Vicky. We have somebody who'll ask questions and time is limited. I can't help slipping in a comment about what you say makes sense. Why is Brexit a word that much of the media can't bring themselves to say, I wonder? Could it be they feel guilty about it?
I can try and answer it, or at least say something about this, if I may.
I appreciate that.
I think that was the case for a while, but it's quite interesting that a lot of the Brexit stories about extra costs, about what's happened to the queues of lorries trying to leave, and all the extra bureaucratic costs of Brexit, have appeared mostly in the Daily Mail, for example, in the Express. I mentioned the Telegraph, and there are daily articles about this. So actually, if anything, the Brexit word is used a lot more, or has been used. Now, of course, the protocol issues have taken over a little bit, and the cost of living thing has taken over a little bit in terms of commenting. But I've been astonished about the number of news reports with negative issues about Brexit. You know, we had it for the fisheries industry, but now we seem to have it all across the sectors, which is interesting, and suggests to me that actually the B word is no longer one cannot easily use. And I use it in all my commentary now more easily without getting any pushback from the presenters, which is quite good.
Thank you.